Before we begin, a quick and important disclaimer. This video is intended strictly for educational and entertainment purposes. The information presented here does not constitute professional legal, financial, or tax advice. Divorce law and retirement asset regulations, including those governing 401k accounts and the Employee Retirement Income Security Act, are highly complex and vary significantly by state and individual circumstances. Economic conditions and market volatility can radically alter potential outcomes. You should not act or refrain from acting based on any information provided in this video without first seeking the counsel of a qualified attorney, a certified financial planner, or a tax professional in your specific jurisdiction. While we strive for accuracy, we make no representations as to the completeness or currentness of the data discussed. Please conduct your own thorough due diligence before making any decisions regarding your financial future. Imagine standing on a precipice where the two most significant pillars of your stability are crumbling simultaneously. On one side, the United States economy is sliding into a recession. The S&P 500 is in the red, consumer confidence is cratering, and your 401k, the vehicle you have spent 20 or 30 years fueling for your golden years, has just lost 20% of its value in a single quarter. On the other side, your marriage, the personal foundation of your life, is ending. You are now facing a mathematical nightmare that few people are truly prepared to navigate: the division of a depreciating asset in a high-stakes legal environment. This is the 401k divorce in an economic recession, and for many Americans, it represents a potential loss of wealth that can take decades to recover from, if recovery is even possible. The historical trends are sobering. During the 2008 financial crisis, we saw a phenomenon where the total value of household retirement assets plummeted, just as the legal costs of separation began to climb. People were forced to divide portfolios that were at their lowest points in a decade, effectively locking in market losses that otherwise might have been temporary. They were selling at the bottom not by choice but by legal mandate. Today, as we look at the shifting tides of the U.S. economy, many individuals find themselves in a similar wealth trap. If you have $500,000 in a 401k and the market drops by 30%, you are down to $350,000. If you then enter a divorce where that remaining $350,000 is split 50-50, you are left with $175,000. In less than a year, your retirement security has been slashed by nearly 65%. This is not just a statistical possibility. It is a recurring case study in how the intersection of family law and macroeconomics can devastate a middle-class or high-net-worth individual's future. The open loop here is simple but terrifying. How do you protect your share of the pie when the pie itself is shrinking and everyone else is trying to take a bite? The problem we are solving today is the lack of a strategic roadmap for this specific crisis. Most divorce advice is written for stable economic times, and most financial advice is written for stable marriages. Rarely do the two overlap with the depth required to survive a recessionary divorce. In this deep dive masterclass, we are going to strip away the surface-level platitudes and look at the hard mechanics of asset division during a downturn. We will explore the vital difference between a date of separation valuation and a date of distribution valuation, a technicality that can literally mean the difference between keeping an extra $100,000 or losing it to market fluctuations during the months your case sits on a judge's desk. We will analyze why a recession might actually be a strategic time to settle for some, while a catastrophe for others, depending on the tax treatment of the assets involved. You will learn why the Qualified Domestic Relations Order, or QDRO, is the most powerful yet misunderstood document in your legal arsenal. We will break down how to use recessionary math to negotiate for other assets that might hold their value better than a volatile stock portfolio, such as real estate or guaranteed pension benefits. This is about more than just numbers. It is about understanding the psychological leverage that a recession provides in a negotiation. When your spouse is terrified of a market crash, their willingness to compromise changes. If you understand the historical data of how retirement plans behave during U.S. recessions, you can move from a position of panic to a position of informed strategy. Today's American landscape is filled with uncertainty. Inflation is eating away at purchasing power, and the Federal Reserve's movements create ripples that hit your 401k directly. When you add the emotional and legal weight of a divorce to this mix, the margin for error becomes razor thin. One wrong move, one poorly timed filing, or one misunderstood tax clause can trigger penalties that wipe out your remaining liquidity. We are here to ensure that you understand the potential outcomes of every move on the board. We will look at case studies of those who navigated the 2000 dot-com bubble burst and the 2020 pandemic volatility to see who came out with their retirement intact and who was left starting from zero at age 55. This masterclass is designed to be your comprehensive guide through the fog. We will cover the granular details of ERISA governed plans, the specifics of how different employers handle 401k splits, and the often overlooked impact of loan balances on a 401k during a divorce. Many people do not realize that if they have taken a loan against their 401k, that debt becomes a massive complicating factor during a recessionary split. If the market is down and you have a loan to pay back, the math gets ugly very fast. We will provide step-by-step details on how to account for these variables so that your settlement is based on reality, not on a balance sheet from 6 months ago that no longer exists. By the end of this 10-part series, you will possess a level of financial and legal literacy that puts you ahead of 99% of people going through this process. You will know exactly what questions to ask your attorney, how to challenge a biased valuation, and how to structure your post-divorce life so that you can capitalize on the eventual market recovery. The U.S. economy has always been cyclical. Recessions end and markets eventually climb back. The goal is to ensure that when that recovery happens, you still have enough skin in the game to benefit from it. We are going to solve the problem of financial paralysis by giving you a clear, data-driven path forward. We are diving deep into the technical, the tactical, and the strategic. No summaries, no shortcuts. Whether you are the one with the 401k or the spouse seeking a fair share, the principles of recessionary valuation apply to you. We are going to look at why equitable distribution does not always mean equal, especially when the assets in question are losing value in real time. We will discuss the impact of attorney fees being paid out of these diminishing funds and how to prevent your legal team from consuming the very retirement you are fighting to save. This is the ultimate guide to 401k divorce during U.S. economic recessions. Let us begin the deep dive into the mechanics of your financial survival. To understand how a 401k is carved up during a U.S. economic recession in 2026, we first have to dismantle the illusion of the balance sheet. When you log into your retirement portal and see a number, say for $100,000, that number is a snapshot of a moving target. In a stable economy, that number is a reliable baseline for negotiation. But in 2026, with the U.S. markets experiencing the kind of turbulence that makes even seasoned investors sweat, that number is effectively a phantom. It represents what the assets were worth at the close of business yesterday, not necessarily what they will be worth by the time a judge signs your final decree. This brings us to the most critical technical hurdle in a recessionary divorce: the valuation date. Imagine a couple in Ohio. Let us call them James and Elena. James has been a software engineer for 15 years and has diligently built a 401k worth $600,000. When Elena files for divorce in early 2026, the market is at a local peak. The legal team records the value of the account as $600,000. However, because the U.S. is entering a period of significant economic contraction, by the time they reach a settlement agreement 6 months later, the market has corrected by 18%. That $600,000 account is now worth $492,000. If the court uses the date of filing as the valuation date, but the actual distribution happens months later, James is suddenly responsible for paying Elena half of a value that no longer exists in reality. He would owe her $300,000, leaving him with only $192,000. This is the math of a financial catastrophe. Historical trends show us that the selection of the valuation date is often the most litigated point in a recessionary divorce. In many U.S. jurisdictions, courts have the discretion to use the date of physical separation, the date of the divorce filing, or the date of the actual trial. In a volatile 2026 economy, the difference between these dates can represent tens or even hundreds of thousands of dollars. The strategy here often involves a deep dive into whether the loss in value is considered active or passive. Active loss would be if James went into the account and made high-risk trades that failed. Passive loss, which is what we see in a recession, is simply the market taking its toll. Generally, courts try to be equitable, meaning they may adjust the distribution to reflect the actual value at the time of the split, but this is never a certainty. It requires precise legal maneuvering and a clear presentation of financial data to ensure one spouse isn't left holding an empty bag, while the other walks away with a windfall based on outdated numbers. Now, let us look at the mechanics of the Qualified Domestic Relations Order, or the QDRO. This is the legal instrument that allows a 401k to be divided without triggering the immediate 10% early withdrawal penalty or standard income tax hits that usually come with taking money out before age 59 and a half. In 2026, the QDRO process is more fraught than ever because of the administrative lag. Once a divorce is finalized, the QDRO must be drafted, approved by the plan administrator, and then executed. This can take anywhere from 3 to 9 months. During a recession, that window of time is a danger zone. If the market drops further during that 9-month wait, the person receiving the funds might receive significantly less than they anticipated if the order was written for a specific dollar amount rather than a percentage. Consider a case study from the 2008 financial crisis, which serves as a vital blueprint for 2026. Many settlements were written with fixed dollar amounts. A spouse might have been awarded exactly $200,000 from their partner's 401k. But as the market cratered, that $200,000 grew to represent a much larger percentage of the total account than originally intended. In some extreme cases, the total account value dropped below the fixed dollar amount awarded to the ex-spouse, leaving the account holder with zero. This is why, in a recessionary environment, the step-by-step detail of how the QDRO is phrased is a matter of survival. Professionals often suggest using percentages combined with a clause for gains and losses. This ensures that both parties share in the market's movement, for better or worse, until the moment the funds are actually moved into a separate account. We also have to discuss the concept of separate property versus marital property in the context of 2026. Not every dollar in that 401k is up for grabs. If James had $100,000 in his 401k before he married Elena, that is his separate property. Only the contributions made during the marriage, and the growth on those contributions, are typically subject to division. However, in a recession, the growth can turn into a loss. How do you calculate the remaining separate property when the overall account value has shrunk? This requires a process called tracing. A financial expert has to go back through years of statements to determine how much of the current, smaller pie belongs to the premarital portion. If the account has lost 20% of its total value, does that 20% come off the marital portion, the separate portion, or both proportionally? Without a detailed tracing analysis, you are essentially guessing with your life savings. There is also the psychological leverage that a recession creates in a divorce negotiation. In a booming economy, people are often more willing to let go of a 401k in exchange for the family home. In 2026, with interest rates remaining unpredictable and the housing market cooling in many U.S. sectors, the math of that trade-off has shifted. A 401k, even one that is currently down, is a liquid asset once the QDRO is processed. You can move it, reallocate it, and eventually it has the potential to grow when the recession ends. A house, on the other hand, comes with property taxes, maintenance, insurance, and a potentially high-interest mortgage. We are seeing more individuals in 2026 fighting harder for the 401k assets because they recognize that buying into the market at the bottom of a recession is one of the most effective ways to rebuild wealth post-divorce. Imagine Sarah and Robert. Robert wants the house because he wants stability for the kids. Sarah realizes that the house is an expense while the 401k is an investment. She agrees to give up her share of the equity in the home if she can keep 70% of the 401k. Because it is 2026 and the market is down, Robert thinks he is getting a great deal. He gets the 3-bedroom home in the suburbs. Sarah gets a retirement account that is currently valued low. But 2 years later, when the U.S. economy begins its recovery, Sarah's 401k value doubles as the market rebounds. Robert is still paying a 6% mortgage and dealing with a roof leak. This is the difference between emotional decision-making and recessionary strategy. Potential outcomes are heavily weighted toward those who can look past the current red numbers and see the long-term trajectory of the assets they are fighting for. Step by step, the process of dividing a 401k in this climate requires an immediate freeze on the account to prevent unauthorized loans or changes in investment strategy by the account holder. Then comes the valuation, the tracing of separate property, the negotiation of percentage versus fixed sum splits, and finally the rigorous drafting of the QDRO. Every one of these steps is a place where wealth can leak out of your pocket if you are not paying attention to the macroeconomic reality. You have to account for the fact that $1 in a 401k is not the same as $1 in a savings account because of the deferred tax liability. If you take $50,000 in cash from a savings account, you have $50,000. If you take $50,000 from a 401k, you eventually have to pay the IRS. In a recession where every penny counts, Failing to account for those future taxes is a mistake that can haunt your retirement. As we move deeper into this masterclass, we have to look at the hidden landmines that can blow up even the best-laid plans. Most people assume their 401k is just a bucket of money sitting there waiting to be split. But what happens if you have been using that bucket as a personal bank? What happens if there is an outstanding loan against the 401k that was taken out to pay for a kitchen remodel or to consolidate credit card debt? In a recession, this loan becomes a tactical nightmare that can lead to unintended tax consequences and a massive reduction in your share of the assets. The way these loans are handled can change the entire landscape of your settlement. In the next part, we are going to break down the specific disaster of 401k loans during a divorce. We will look at how an unpaid loan can be treated as a distribution, triggering taxes and penalties at the worst possible time, and who is legally responsible for that debt. If you or your spouse has borrowed against your retirement, you are walking into a minefield that most attorneys aren't even equipped to handle. We will reveal how to neutralize that threat before it destroys your remaining equity. The 401k loan is the ticking time bomb of retirement division, and in the volatile economic landscape of 2026, that bomb is often set to a much shorter fuse. To understand the gravity of this, we have to look at how these loans actually function under the hood of the Internal Revenue Code. When you take a loan from your 401k, you are not borrowing from a bank, you are borrowing from your future self. You are effectively selling your own shares of mutual funds or stocks within the plan to generate cash, and you are then paying yourself back with interest. In a booming economy, this is a manageable, if suboptimal, financial move. But when a recession hits and a divorce filing follows, this loan transforms from a simple internal transaction into a massive legal and tax liability that can derail a settlement before it even reaches a judge's desk. Imagine a scenario in mid-2026 involving a project manager in Seattle named Michael. Michael has a 401k with a gross balance of $250,000. 2 years ago, he and his wife, Linda, decided to take a $50,000 loan from that account to fund a major home renovation, thinking the market would continue its upward trajectory. Now, in the face of a U.S. economic downturn, Michael's company is downsizing, and he is facing a potential layoff. Simultaneously, Linda has filed for divorce. This is where the recessionary math becomes brutal. The first step in any deep dive into 401k loans is the characterization of the debt. In the U.S. legal system, the question is not just who took the loan but what the money was used for. If Michael used that $50,000 to improve the marital home, most U.S. courts will view that $50,000 loan as marital debt. This means the debt should be shared equally. However, if Michael took the loan to fund a solo business venture that failed or for personal expenses after the date of separation, it might be classified as his separate debt. In a recession where every $1,000 of liquidity is vital, the fight over this characterization becomes intense. Historical trends show that during the 2008 financial crisis and the 2020 market shock, the treatment of 401k loans was a primary source of post-divorce litigation. The problem lies in the net versus gross valuation. On Michael's 401k statement, it might show a balance of $250,000, but the actual cash value available for division is only $200,000, because that $50,000 loan is an outstanding obligation. If Linda's attorney argues for a 50-50 split of the gross balance, she is asking for $125,000. If the court grants this, Michael is left with $75,000 in cash value and a $50,000 debt to himself. But here is where the 2026 recessionary pressure makes it worse: the layoff factor. Most 401k plans require that if an employee is terminated or leaves the company, any outstanding loan must be repaid in full within a very short window, often 60 to 90 days. If Michael is laid off during the divorce process, as is common in a recession, and he cannot afford to pay back that $50,000 because his liquidity is tied up in legal fees and declining home equity, the IRS steps in. The unpaid loan is declared a deemed distribution. A deemed distribution is a catastrophic event in a divorce. The IRS treats that $50,000 as taxable income for the year 2026. If Michael is in a 24% tax bracket, he suddenly owes $12,000 in federal income taxes. If he is under the age of 59 and a half, he also gets hit with a 10% early withdrawal penalty, adding another $5,000 to the bill. Suddenly, a $50,000 loan has cost him $17,000 in immediate tax liability. In a divorce settlement, the question becomes, who pays that tax? If the loan was marital, should Linda be responsible for half of the tax and penalty? Case studies from previous downturns suggest that unless the settlement specifically addresses the tax consequences of a potential loan default, the person whose name is on the 401k is usually the one left holding the bag. Step by step, you must analyze the plan document itself. Not all 401k plans are created equal. Some plans allow for the transfer of a loan balance through a qualified domestic relations order, but this is extremely rare. Most plan administrators will not allow a loan to be split. This means the loan must either be paid off before the divorce is finalized, or one spouse must take the loan as part of their share of the assets, effectively offsetting it against other property. For example, if Michael and Linda have a joint savings account with $60,000, they might agree to use $50,000 of that to pay off the 401k loan before the split. This cleans up the 401k balance to a full $250,000, which can then be cleanly divided into $125,000 each via a QDRO. This is often the cleanest potential outcome, but in a recession, couples rarely have $50,000 in liquid cash just sitting around. Most of their liquidity is likely being consumed by the rising cost of living and legal retainers. If you cannot pay it off, you have to look at the offset strategy. This involves complex spreadsheet modeling. You have to calculate the present value of the 401k, subtract the loan, and then factor in the latent tax liability. A savvy negotiator in 2026 will argue that the 401k is worth less than its face value because of the taxes that will eventually be due. If Michael keeps the $200,000, $401,000 and the $50,000 loan, he shouldn't just be credited with $200,000 in assets. He should be credited with the net after-tax value. If he is going to owe $40,000 in taxes eventually, that $200,000 is really only worth $160,000. In a recession where every dollar is a prisoner, failing to do this math can lead to a settlement that looks fair on paper but is a functional disaster in practice. We also have to consider the impact of the QDRO on the loan. Many QDROs are drafted poorly, stating that the alternate payee, in this case Linda, is entitled to 50% of the account balance. If the plan administrator interprets the balance as the gross amount including the loan, but the loan cannot be transferred, the system can glitch. The administrator might take $125,000 out of the $200,000 in available cash, leaving Michael with only $75,000 in cash and the entire $50,000 debt. He is now forced to pay back a loan that funded a kitchen in a house Linda might now own, using a significantly smaller pool of remaining assets. This brings us to the importance of the 1099-R form. In a recessionary divorce, the timing of when this form is issued by the IRS can make or break your financial recovery. If a loan is defaulted on during the divorce, the 1099-R will be issued to the primary account holder. If the divorce isn't final, and they are still filing jointly, both spouses share the tax hit. But if they are filing separately, the primary account holder bears the entire brunt. This creates a perverse incentive for the non-account holding spouse to drag out the divorce until a layoff occurs, forcing a loan default that they won't be responsible for. To navigate this, you need to demand a full loan history during the discovery phase of the divorce. You need to see exactly when the money was taken, where it went, and what the current repayment schedule looks like. You must also check if the plan allows for a collateralized split, where the loan stays with the original participant, but the value of the loan is deducted only from their portion of the total assets. This is the level of granular detail that separates a successful recessionary divorce from a total financial wipeout. But even if you manage to solve the loan puzzle, you are still facing a hidden enemy. The IRS is not the only third party sitting at your negotiation table. There is another invisible force that can take a massive bite out of your 401k, regardless of how you split it. Most people focus on the division of the principal, but they completely ignore the tax-deferred nature of the growth. In the next part, we are going to expose the hidden tax traps of the 401k split. We will look at why $100,000 in a 401k is fundamentally worth less than $100,000 in a Roth IRA, and how the 2026 tax brackets could turn your settlement into a tax nightmare you never saw coming. We will reveal the secret to balancing the tax load, so you don't end up subsidizing your ex-spouse's retirement for the next 30 years. The core of the tax nightmare lies in the fundamental misunderstanding of what a dollar is worth inside a retirement account. Most people looking at their 401k statements in 2026 see a gross number, but that number is a pre-tax mirage. In a recession where every percentage point of your net worth is under siege, failing to account for the tax-deferred nature of these funds is like trying to build a house with only 3 walls. You are essentially sharing a debt to the Internal Revenue Service with your ex-spouse, and how that debt is allocated can determine whether you thrive or struggle in your post-divorce life. Imagine a case study involving a couple in Virginia, David and Jessica. They are finalizing their divorce in mid-2026. After years of work, they have two primary assets of seemingly equal value. David has a traditional 401k worth $400,000. Jessica has a Roth IRA worth $300,000 and $100,000 in a high-yield savings account. On a standard balance sheet provided by a general practice attorney, both David and Jessica appear to be walking away with $400,000 in assets. It looks like a perfect 50-50 split. However, this is a mathematical illusion that ignores the reality of the U.S. tax code in 2026. In the year 2026, we are navigating a shifting tax landscape. Many of the tax provisions from previous years have evolved, and for someone like David, every dollar he withdraws from that traditional 401k in the future will be taxed as ordinary income at whatever the prevailing rates are at that time. If we assume a modest combined federal and state tax rate of 25%, David's $400,000 account is actually only worth $300,000 in spendable, after-tax liquidity. Jessica, on the other hand, has $300,000 in a Roth IRA, which is qualified for tax-free withdrawals, and $100,000 in cash. Jessica is walking away with a true net value of $400,000, while David is walking away with $300,000. By failing to tax-adjust the assets, David has essentially handed Jessica an extra $100,000 without even realizing it. Historical trends show that during economic downturns, the pressure to reach a quick settlement often leads to these kinds of face value errors. When the market is volatile, as it is in 2026, people focus on the total number they see on the screen rather than the quality of the dollars behind that number. Step by step, a professional analysis of this situation requires calculating the net of tax value of every single asset. You must apply a projected tax rate to the traditional 401k balances before comparing them to post-tax assets like Roth accounts, savings, or even home equity. Imagine if Jessica, in our scenario, needs immediate liquidity because the 2026 recession has led to a reduction in her hours at work. If she receives $200,000 from David's 401k via QDRO, she can choose to take a portion of that as a direct cash distribution rather than rolling it all into an IRA. While she will still owe ordinary income tax on that cash, she avoids the 10% penalty that would usually apply. In a recession where credit is tight and personal loans are expensive, this QDRO cash out can be a vital lifeline. But there is a catch. This exception only applies if the money comes directly from the employer-sponsored 401k plan as part of the QDRO process. If Jessica rolls the money into her own IRA first and then tries to withdraw it, the 10% penalty usually applies again. This is a one-time opportunity that requires precise timing and coordination with the plan administrator. Furthermore, we must look at the impact of the 2026 tax brackets on these distributions. If David's 401k is large and the split happens in a way that forces a large distribution in a single tax year, it could push the recipient into a much higher tax bracket. This is why a strategic settlement might involve spreading the QDRO payments over 2 different tax years, or balancing the 401k split with other, non-taxable assets. In a recession, the last thing you want to do is hand over a massive chunk of your settlement to the IRS because of poor timing. We also need to address the basis in a 401k. While most 401k contributions are pre-tax, some individuals make after-tax contributions to their plans. If David had made after-tax contributions, a portion of his $400,000 account would be tax-free upon withdrawal. During the discovery phase of a 2026 divorce, it is essential to request the summary plan description and the specific contribution history to identify these after-tax dollars. If you are the spouse receiving the funds, you want to ensure that a proportional share of that tax-free basis is assigned to you in the QDRO. Otherwise, your ex-spouse keeps the tax-free money while you are stuck with the fully taxable portion. Case studies from the 2000 and 2008 recessions highlight how many people ignored these details and ended up with significantly less retirement security than they anticipated. They thought they were being fair by splitting everything down the middle, but the tax code is not interested in your definition of fairness. It only cares about the character of the asset. In 2026, with the U.S. government looking for ways to shore up revenue, tax enforcement and bracket adjustments are a constant variable. You must negotiate based on real-world dollars, which means dollars you can actually spend. Consider the imagine-if scenario where you are negotiating for the family home versus the 401k. In a recession, the home's value might be stagnant, and selling it could involve high transaction costs and commissions. If you trade your share of a tax-deferred 401k for the home, you are trading expensive tax burden dollars for clean home equity dollars. On the surface, this might look like you are losing out if the dollar amounts are equal. But when you factor in that the $401,000 is only worth 75 cents after taxes, suddenly the home equity looks much more attractive. This is the kind of three-dimensional chess required to survive a 2026 divorce. Potential outcomes in these situations are often dictated by who has the better financial forensic team. You need to look at the unrealized tax liability as a debt. Just as you would subtract a mortgage from the value of a house to find the equity, you must subtract the projected tax liability from the 401k to find its true value. If your spouse refuses to acknowledge this, they are essentially asking you to pay their future taxes. Step by step, you should: first, identify all retirement accounts and their tax status, traditional, Roth, or after tax. Second, apply your current and projected tax brackets to these figures. Third, determine if you need immediate liquidity, and if the 72T QDRO exception is a viable path for you. Fourth, ensure the QDRO language specifically addresses the allocation of tax basis. As we master the tax implications, we hit another wall that many don't see until it's too late. The 401k is not a stagnant pool. It is an engine that is constantly moving. While you are arguing over tax brackets and basis, the underlying investments are changing every second the market is open. In a recession, this volatility can be used as a weapon. If one spouse has control over the account during the divorce, they have the power to rebalance the investments in a way that could disadvantage the other party. In the next part, we are going to explore the danger of investment maneuvering during a divorce. We will reveal how an account holder can shift assets into safe low-growth funds just before a market recovery, or into high-risk assets during a crash, effectively gambling with their ex-spouse's future. We will show you how to lock down the investment strategy, so you aren't a victim of market manipulation or spiteful management. The 401k is not a static vault of cash. It is a live, breathing engine of fluctuating assets, and in the high-volatility environment of 2026, that engine can be steered in ways that either preserve or evaporate your future. When a divorce filing hits the desk, the person who holds the login credentials for that 401k suddenly possesses a form of tactical leverage that is rarely discussed in standard legal brochures. This is the domain of investment maneuvering, a strategy that can be used for legitimate risk management or, in more sinister cases, as a tool for financial scorched earth. To protect yourself, you must understand how the mechanics of asset allocation interact with the timeline of a U.S. divorce. Imagine a case study involving a couple in North Carolina, Mark and Diane. Mark is a senior analyst with a 401k valued at $800,000 at the start of 2026. As the U.S. economy begins to signal a deepening recession, the market experiences a sharp 15% correction. Mark, who is the sole participant in the plan, feels a sense of resentment about the upcoming asset division. He knows that in a few months a judge will likely award Diane 50% of that account. He looks at the current market carnage and sees an opportunity. Mark decides to rebalance the entire portfolio. He moves the $800,000 out of diversified index funds and into highly speculative, triple-leveraged inverse ETFs, betting heavily on a further market collapse. In this imagine-if scenario, if Mark is right, the account might skyrocket, but if he is wrong and the market rallies, the account could be wiped out by 50% in a matter of days. This is what professionals call investment dissipation, or the waste of marital assets. In the context of a 2026 recession, the line between a savvy investment move and a spiteful gamble is incredibly thin. If Mark loses $400,000 of the marital pot through reckless maneuvering during the divorce, Diane's legal team will argue that Mark violated his fiduciary duty to the marital estate. U.S. courts generally hold that once a divorce is initiated, both spouses have a duty to preserve the marital assets. Reckless speculation during a downturn is a high-stakes violation that could result in the court awarding Diane her full $400,000 from Mark's remaining share, effectively leaving him with nothing. Historical trends from the 2008 financial crisis show a recurring pattern where account holders, paralyzed by fear or motivated by spite, move their 401k balances to cash at the very bottom of the market. While this might seem like a safe move, it effectively locks in the losses and prevents the account from participating in the eventual recovery. If the divorce settlement is based on the value of the account at the date of separation, but the actual division happens a year later after a market rebound, the non-account holding spouse might miss out on hundreds of thousands of dollars in growth because the other spouse decided to sit in cash. In 2026, with the speed of market shifts, this administrative lag is a silent wealth killer. Step by step, the first line of defense against investment maneuvering is the implementation of automatic temporary restraining orders, or ATROs. In many U.S. states such as California or New York, these orders go into effect the moment the summons is served. They legally prohibit either spouse from hiding, transferring, or dissipating assets. However, a common misconception is that ATROs prevent you from touching your 401k at all. Most orders allow for transactions made in the usual course of business or for the necessities of life. This creates a massive gray area. Is rebalancing a 401k to move from stocks to bonds during a 2026 recession a transaction in the usual course of business? Most plan administrators will allow it because they are not parties to the divorce and only follow the instructions of the plan participant. To neutralize this threat, the non-account holding spouse must take proactive steps. Step 1. Immediately request the last 2 years of 401k statements to establish a baseline of what the investment strategy looked like before the divorce was a factor. If the account holder suddenly changes a conservative strategy to a hyper-aggressive one after the filing, that is a red flag for the court. Step 2. File a formal notice with the plan administrator informing them of the pending divorce. While the administrator may not be able to stop a trade, having this notice on file creates a paper trail that can be used in court to prove that the participant was aware of their obligations. Step 3. Seek a specific court order that requires joint consent for any changes in asset allocation, exceeding a certain percentage of the account. For the account holder, the strategy is different. You must avoid the appearance of impropriety. If you feel the need to move to safer assets due to the 2026 economic climate, you should document the rationale. Ideally, you should obtain a written recommendation from a third-party financial advisor that states the move is a standard defensive posture for a recession. Without this documentation, your move to cash might be interpreted as an attempt to freeze out your spouse from future gains, a move that could lead to a judge adjusting the final distribution in your spouse's favor to compensate for the lost opportunity. We must also look at the technicality of gains and losses during the pendency of the divorce. If the court orders that Diane is to receive 50% of the 401k as of the date of filing, does she also get 50% of the growth or loss that occurs between the filing date and the actual transfer date? This is a crucial point of negotiation. In a 2026 recession, where the market might swing 5% in a week, failing to specify that the award includes gains and losses is a massive oversight. If the account grows by $100,000 during the year it takes to finalize the divorce, and the order only specifies a fixed dollar amount from the filing date, the account holder keeps the entire $100,000 gain. Conversely, if the market drops, the account holder is stuck paying out a value that no longer exists. Case studies from previous U.S. recessions suggest that the most equitable potential outcomes occur when the QDRO is drafted to award a percentage of the account, adjusted for investment earnings and losses, from the valuation date to the date of distribution. This ensures that both parties share the market risk and the market reward. It removes the incentive for the account holder to gamble with the funds, as they know their spouse will share in whatever the outcome is. However, even if you lock down the investment strategy and account for every gain and loss, there is another layer of complexity that can ruin your 2026 financial plan. A 401k is often tied to your employment, and in a recession, employment is never a certainty. If the account-holding spouse loses their job or the company goes under during the divorce, the 401k becomes subject to a completely different set of rules. The plan might be terminated, or the participant might be forced to roll it over into an IRA, which can bypass the protections of the QDRO you spent months negotiating. In the next part, we are going to dive into the nightmare scenario of job loss and company bankruptcy during a recessionary divorce. We will reveal what happens to your 401k when the employer who sponsors it disappears. We will look at the safety nets provided by the Pension Benefit Guaranty Corporation, and why they might not be enough to save your 401k. Most importantly, we will show you how to structure your settlement to protect against the very real possibility of a 2026 layoff destroying your retirement distribution before it even starts. The administrative architecture of a 401k is built on the assumption of a stable employer-employee relationship, but in the volatile economic climate of 2026, that assumption is a luxury you can no longer afford. When a U.S. company faces a recessionary squeeze, its first instinct is to reduce headcount or, in extreme cases, file for restructuring. For someone in the middle of a divorce, a layoff is not just a career crisis. It is a legal reset button that can render months of negotiation completely void. To navigate this, you must understand the mechanical difference between an active 401k and a terminated or rolled over account. Imagine a case study involving a financial analyst in Chicago named Thomas. Thomas has been with his firm for 12 years and has accumulated $750,000 in his 401k. He and his wife, Amanda, are in the final stages of a divorce where they have agreed to a 50-50 split of the retirement assets. The lawyers have drafted a Qualified Domestic Relations Order, or QDRO, specifically naming Thomas's current employer-sponsored plan. However, before the judge can sign the order and before the plan administrator can process it, Thomas's firm announces a massive downsizing in late 2026. Thomas is laid off. In most standard 401k plans, when an employee is terminated, they are given a choice. Leave the money where it is or roll it over into an individual retirement account or IRA. If Thomas, in a moment of financial panic or simply following standard severance advice, rolls that $700,000 into a new Vanguard or Fidelity IRA, the QDRO that Amanda's lawyer spent thousands of dollars drafting becomes a worthless piece of paper. Why? Because a QDRO is a legal instrument specifically designed for ERISA-governed employer plans. An IRA is not governed by ERISA in the same way. It is governed by different sections of the Internal Revenue Code. The entity that the QDRO was directed to, the employer's plan, no longer holds the assets. This creates a massive procedural loophole. Amanda now has to start over. She has to get a new court order, likely a letter of instruction or a different type of domestic relations order, to move the money from the IRA. During this administrative lag, the market is still moving. In a 2026 recession, those 3 to 6 weeks of administrative chaos could coincide with the 10% market swing. If the original agreement was for a specific dollar amount, Thomas might now find himself unable to fulfill the obligation because the value has shifted, or Amanda might find herself chasing a moving target. Historical trends during the 2008 financial crisis show that thousands of spouses lost out on their fair share of retirement assets because of this exact scenario. They focused on the total value of the 401k but ignored the stability of the sponsor. Step by step, you must protect yourself against the 2026 layoff risk. Step 1 is the implementation of a joinder. In some states, you can legally join the 401k plan itself as a party to the divorce. This puts the plan administrator on formal notice that they cannot allow a total rollover or distribution without accounting for the spouse's interest. If Thomas's plan had been joined to the action, the administrator would have been legally barred from allowing him to move the entire balance to an IRA without Amanda's signature. Step 2 involves the specific wording of your settlement agreement. A professional script for a 2026 divorce settlement should include a successor plan clause. This clause states that the spouse's interest attaches not just to the specific 401k plan, but to any successor plan or account that the funds are moved to, whether it is an IRA, a new employer's 401k, or a cash distribution. Without this language, you are essentially betting your retirement on the hope that your ex-spouse keeps their job until the paperwork is finished. Now let us look at the even more complex scenario of company bankruptcy. Imagine if the employer sponsoring the 401k doesn't just lay off employees but ceases to exist entirely. This is a very real possibility in the 2026 U.S. economic landscape. The good news is that under the Employee Retirement Income Security Act, or ERISA, your 401k assets are held in a trust that is separate from the company's general assets. If the company goes bankrupt, its creditors cannot touch your 401k. However, the administrative side of the plan becomes a ghost town. In this imagine-if scenario, the person who usually processes your QDRO, the HR director or the third-party administrator, might be fired. The plan may become what the Department of Labor calls an abandoned plan. If this happens during your divorce, the timeline for receiving your distribution could stretch from months into years. You would be forced to deal with a court-appointed fiduciary, whose only job is to liquidate the plan and distribute the funds to all participants. In a recession, this liquidation often happens at the worst possible time, forcing you to sell your shares when the market is at its lowest point. Potential outcomes in an abandoned plan scenario are often dictated by how quickly you can assert your status as an alternate payee. Historical trends suggest that many ex-spouses fail to realize that they are not considered participants in the plan until the QDRO is qualified. If the plan is terminated before your QDRO is qualified, you are just another creditor in the eyes of the fiduciary. This is why, in 2026, the speed of the QDRO process is more important than the negotiation of the split itself. A 50% split that is qualified is worth infinitely more than a 60% split that is stuck in a terminated plan. We also have to consider the risk of the 401k loan we discussed earlier. If an employee is laid off during a 2026 recession, that loan usually becomes due immediately. If the employee cannot pay it back, it is treated as a distribution. If this happens while a divorce is pending, it shrinks the total pot available for the other spouse. You must ensure your legal team includes an indemnification clause. This clause states that if the account holder triggers a tax event or a reduction in the account value due to a loan default following a layoff, their share of the other marital assets, like the house or the bank accounts, will be reduced to compensate the other spouse. Step by step, if a layoff occurs, you need to first, immediately file a motion with the court to freeze the movement of the 401k funds. Second, demand a new statement from the plan to see if any automatic liquidations have occurred. Third, update the QDRO language to reflect the new status of the funds. Fourth, consult a tax professional to see if the layoff-triggered distribution allows for any specialized tax treatment under the 2026 code. The 2026 recession is a stress test for your divorce strategy. It reveals the cracks in standard legal forms and the dangers of administrative complacency. You cannot assume that the employer will be there tomorrow, and you cannot assume the plan will remain active. You have to treat the 401k like a moving vehicle that could run out of gas at any moment. You need a plan for where the money goes when the engine stops. But while the 401k is often the largest single asset, it is rarely the only retirement vehicle on the table. For many Americans, especially those in the public sector or older industries, there is another, even more complex asset that is often misunderstood and improperly valued during a recession: the defined benefit pension. Unlike a 401k, which is a bucket of money, a pension is a promise of future income. In a recession where interest rates are fluctuating wildly, the present value of that future promise can swing by hundreds of thousands of dollars. In the next part, we are going to dive into the world of pension division and Social Security offsets. We will reveal why a recession might make your pension the most valuable thing you own, or a liability that could drain your other assets. We will look at the coverture fraction, the impact of early retirement incentives offered during layoffs, and how to ensure you aren't trading a solid gold pension for a 401k that might never recover. We will show you how to calculate the real value of a lifetime of checks in an era of economic uncertainty. While the 401k is a visible and fluctuating bucket of money, the defined benefit pension is a different animal entirely, often representing a hidden reservoir of wealth that many spouses overlook or undervalue during the heat of a 2026 recession. To survive this stage of the masterclass, you must understand that unlike a 401k, where the risk of the market lies on your shoulders, a pension is a promise made by an employer to pay a specific monthly benefit for the rest of your life. However, in a divorce, we aren't just looking at a monthly check 30 years from now. We are looking at the present value of that promise today. In a 2026 economy characterized by shifting interest rates and corporate restructuring, the math used to determine that value is one of the most contentious battlegrounds in family law. Imagine a case study involving a couple in Michigan named Carlos and Maria. Carlos has worked for a major utility company for 22 years and is entitled to a traditional pension. Maria has a 401k worth $300,000. As they navigate their 2026 divorce, Maria's attorney suggests a simple trade. Maria keeps her 401k, and Carlos keeps his pension. On the surface, this might seem like a clean break. Carlos knows his 401k balance is lower than Maria's, so he thinks he is winning. But this is where the lack of actuarial data can lead to a massive transfer of wealth. The first step-by-step detail you must master is the actuarial valuation. To determine what Carlos's pension is worth today, a professional actuary must look at his projected monthly benefit, his life expectancy based on 2026 mortality tables, and most importantly, the discount rate. In a recessionary environment like 2026, interest rates are the invisible hand that moves the needle. If the Federal Reserve has raised interest rates to combat inflation, the present value of a pension actually drops. Conversely, if rates are low, the present value skyrockets. If Carlos's pension is valued at a 5% discount rate, it might be worth $500,000 today. If Maria trades her $300,401,000 for that, she is effectively losing $200,000 in the deal. Historical trends show that during the high-interest periods of the past, many spouses gave up rights to pensions that ended up being the most valuable asset in the entire marital estate. Now, let us look at the mechanics of the division, specifically the coverture fraction. This is the formula used in nearly every U.S. jurisdiction to determine what portion of a pension is marital and what portion is separate. The numerator is the number of months or years Carlos worked for the company while married to Maria. The denominator is the total number of months or years Carlos worked for the company in total. Imagine if Carlos worked for 22 years, but he and Maria were only married for 11 of those years. The coverture fraction is 11 divided by 22, or 50%. This means that only half of the pension's value is considered marital property. If the total present value is $500,000, the marital portion is $250,000. In a 2026 recession, where Carlos might be facing an early retirement incentive or a layoff, the timing of this calculation is vital. This brings us to the scenario of the early retirement incentive, often called a golden handshake. In mid-2026, as companies look to slash payroll costs, they may offer long-term employees like Carlos a lump sum or an increased monthly benefit to retire early. The legal question that arises in a divorce is whether that incentive is considered marital property or a post-separation replacement for future earnings. Case studies from the 2008 and 2020 downturns suggest that if the incentive is based on years of service that occurred during the marriage, the ex-spouse is likely entitled to a portion of it. If Maria's legal team is not watching the corporate announcements of Carlos's employer, she might miss out on a six-figure retirement bonus that was technically earned during their marriage. We also have to address the complex world of Social Security offsets. This is a technicality that often shocks people in states like Ohio, California, or Illinois, where many public employees, such as teachers or police officers, do not pay into the Social Security system. Instead, they have robust pensions. In a 2026 divorce, if Maria has worked in the private sector and paid into Social Security, while Carlos has worked as a teacher and has a pension, a simple 50-50 split of the pension can be wildly inequitable. Maria's Social Security benefits are generally not divisible in a divorce under federal law. However, Carlos's pension is divisible. Some U.S. courts will apply a Social Security offset, essentially pretending that Carlos has a Social Security benefit of a certain value and subtracting that from Maria's claim to his pension. This prevents one spouse from keeping their entire Social Security check, while also taking half of the other spouse's pension. Failing to account for this offset in a recession can leave the private sector spouse with significantly less total retirement income. A massive risk in pension division is the survivor benefit. Imagine if the divorce decree says Maria gets $500 a month from Carlos's pension once he retires. If the QDRO is not drafted with a pre-retirement survivor annuity and a post-retirement survivor annuity, and Carlos dies a week before he retires, Maria gets zero. The pension simply vanishes back into the plan's trust. In the high-stress environment of a 2026 recession, ensuring that these survivor protections are locked in is a matter of life and death for your financial security. You must ensure the court order specifies that the ex-spouse is to be treated as the surviving spouse for the purposes of these benefits. Furthermore, we must consider the impact of inflation-adjusted versus fixed-payment pensions. In 2026, with the U.S. economy grappling with the long-term effects of currency devaluation, a pension that includes a cost of living adjustment or COLA is a premium asset. A 401k can be depleted, but a COLA-adjusted pension grows with the cost of milk and eggs. If you are negotiating a split, you should be willing to fight harder for a piece of a COLA-adjusted pension than a stagnant 401k balance. Potential outcomes for those who prioritize inflation-protected income are significantly better than for those who chase a flat dollar amount that might lose half its purchasing power over the next 20 years. Step by step, the process for pension division is as follows. First, obtain the summary plan description to see if the plan is a traditional pension or a hybrid. Second, hire a certified pension valuator to determine the present value based on 2026 economic data. Third, calculate the coverture fraction to isolate the marital portion. Fourth, determine if a Social Security offset applies to your specific state and situation. Fifth, and most importantly, ensure the QDRO explicitly includes survivor benefit protections. But even with the pension and 401k secured, there is a final, darker level to the recessionary divorce. In a 2026 downturn, the pressure for immediate cash often leads people to make desperate moves. They start looking at assets that are even harder to value and easier to hide, things like restricted stock units, non-qualified deferred compensation, and the ultimate recessionary wildcard, cryptocurrency and digital assets held within self-directed retirement accounts. In the next part, we are going to expose the world of executive compensation and the hidden retirement assets. We will reveal how high earners hide wealth in 2026 through sophisticated deferred compensation plans and how to track down digital assets that your spouse might be losing in the market crash. We will look at the forensic accounting techniques needed to uncover these buckets of wealth before they are moved offshore or into untraceable wallets. If you suspect your spouse is downplaying their true net worth because of the recession, the next section is where we find the missing millions. When we enter the upper echelons of corporate America, the simple 401k is often just the tip of a very large and very complex financial iceberg. In 2026, as the U.S. economy navigates through a period of contraction and volatility, high earners and executives are increasingly using sophisticated vehicles to shield their wealth. If you are divorcing a spouse with a high-level corporate role, you are no longer just looking for a bucket of money. You are looking for a series of complex legal contracts that represent future wealth. These assets, specifically restricted stock units or RSUs, non-qualified deferred compensation or NQDC, and digital assets held within self-directed IRAs, are where the true battle for retirement equity is fought. Imagine a case study involving an executive in Austin, Texas, named Kevin. Kevin is a vice president at a major tech firm. On his standard financial disclosure, he lists a 401k worth $500,000 and a savings account with $50,000. To his wife Lisa, this seems like a straightforward 50-50 split. However, what is not immediately visible on the balance sheet is Kevin's restricted stock unit package. In 2026, many tech companies have shifted away from traditional stock options toward RSUs to retain talent during the recession. Kevin has $3 million worth of RSUs that are scheduled to vest over the next 4 years. In a recessionary environment, the valuation of these RSUs is a mathematical minefield. Because the stock price of Kevin's company has dropped 40% in the last year, he might argue that these units are currently worth very little, or that they shouldn't be considered marital property because they haven't vested yet. This is where the concept of the Nelson formula or the Lynch formula comes into play. In the U.S. legal system, these formulas are used to determine the marital portion of unvested stock. The logic is simple. If the stock was granted as a reward for work performed during the marriage, it is a marital asset, regardless of when it actually lands in the account. Step by step, the discovery process for RSUs in 2026 requires more than just a quick look at a pay stub. You must demand the original grant agreement and the vesting schedule. In a recession, companies often reprice or regrant units to keep employees from leaving when their original grants go underwater. If Kevin received a new grant in early 2026 to make up for the market crash, Lisa's attorney must argue that this new grant is a replacement for marital wealth that evaporated, not a brand new post-separation incentive. Failing to track the lineage of these grants during a downturn can result in millions of dollars being left on the table. Beyond RSUs, we have the shadow world of non-qualified deferred compensation, or NQDC. These plans allow executives to defer a massive portion of their salary and bonuses into a tax-advantaged account that sits outside the protections of ERISA. Unlike a 401k, which is held in a separate trust, NQDC is technically an unsecured promise from the employer to pay the employee in the future. In 2026, this creates a unique recessionary risk. If Kevin's company faces a liquidity crisis or files for Chapter 11 bankruptcy, that NQDC account could be wiped out or significantly reduced. Historical trends show that during the 2008 and 2020 economic shocks, many executives tried to dump their NQDC assets on their ex-spouses during divorce negotiations. They would offer the spouse the full value of the deferred compensation in exchange for keeping the 401k or the house. If the company remains stable, the spouse gets a windfall. But if the company fails, the spouse is left with an unenforceable claim against a bankrupt entity. In 2026, if you are negotiating for a piece of an NQDC plan, you must realize you are not just an owner. You are an unsecured creditor. You must conduct a deep dive credit analysis of the sponsoring company before accepting these assets as part of your settlement. Now let us look at the most modern and most easily hidden asset in the 2026 landscape: the self-directed IRA containing cryptocurrency or other digital assets. As traditional markets have struggled, many individuals have moved their retirement funds into STIRAs to invest in Bitcoin, Ethereum, or private equity. These accounts are often managed by niche custodians that do not appear on standard credit reports or bank sweeps. Imagine if Kevin has been quietly moving $5,000 a month into a self-directed IRA, and purchasing digital assets. Because these accounts often do not issue traditional 1099 or forms until a distribution occurs, they can remain invisible for years. To find these, a forensic accountant in 2026 must look for the breadcrumbs. Step by step, you look for transfers to unknown LLCs or specialized custodians. You look for Schedule B on the tax return to see if any small interest payments are being reported from obscure sources. You look for the digital asset question on the 1040 tax form, which in 2026 is a primary tool for the IRS to track non-reporting. If a spouse checks no on that box but you find a transaction to a crypto exchange on a bank statement, you have just found the leverage needed to challenge the entire financial disclosure. The potential outcomes for those who ignore these shadow retirement assets are devastating. In a recession, the value of these assets is often at a temporary low, making it the perfect time for a savvy spouse to hide them by downplaying their significance. They might claim a digital wallet is lost, or that a private equity investment is now worthless. But historical data shows that these assets are often the first to rebound when the U.S. economy enters a recovery phase. If you settle based on a recession bottom valuation without a clawback provision, you are essentially giving away the upside of the next decade. To protect yourself in 2026, your settlement must include a catch-all disclosure clause. This clause states that any asset not disclosed during the divorce process that is later discovered will be subject to a massive penalty, often 100% of the asset's value being awarded to the other spouse. In a recession where the temptation to hide a little extra for the lean years is high, this clause is your ultimate insurance policy. Step by step, your forensic discovery checklist should include: first, a 5-year look back on all W-2s to check for Box 11, which indicates non-qualified plan distributions. Second, a request for all grant agreements and award letters from the employer, not just the current account statements. Third, a specialized subpoena to the employer's HR department for any side letters or retention agreements that might not be part of the standard benefit package. Fourth, a professional crypto trace, if there is any history of digital asset trading in the marital bank accounts. As we peel back the layers of these executive secrets, we realize that the 401k is just the beginning of the story. But even when you have found all the assets, the hardest part remains: the exit. In a 2026 recession, the timing of your final decree can change the value of your settlement by 6 figures in a single afternoon. You can do everything right, find the hidden accounts, value the pensions, account for the loans, and still lose it all if you do not understand the mechanics of the final distribution window. In the next part, we are going to master the final execution of the divorce. We will reveal the hidden dangers of the market transition period, between the judge signing the papers and the money actually moving. We will look at how to use price floors and volatility caps, in your legal language, to ensure that a sudden market crash on the day of your divorce doesn't leave you with half of nothing. We will show you how to navigate the final paperwork, so that the IRS doesn't take a bite out of your settlement on its way to your new account. We are entering the endgame, where the winners and losers of the 2026 recessionary divorce are officially decided. The final distribution window is the most dangerous period of your entire divorce journey, especially in the volatile U.S. economy of 2026. You have survived the discovery phase, you have negotiated the split, and the judge has finally signed the decree. Most people at this stage exhale and assume the hard work is over. But in reality, you have just entered a high-stakes administrative vacuum where your wealth is most vulnerable to market shifts, clerical errors, and tax traps. This is the period between the legal finalization of the divorce and the actual movement of assets from the 401k into a new account. In a stable market, this delay is a mere nuisance. In 2026, with the U.S. markets experiencing intraday swings of 3 to 5%, this delay is a structural risk that can systematically dismantle your settlement. Imagine a case study involving a couple in Phoenix named Robert and Jennifer. They reached a settlement in late 2026 where Jennifer was awarded exactly $300,000 from Robert's 401k to be transferred via a qualified domestic relations order. At the moment the judge signed the papers, that $300,000 represented exactly 50% of the account. However, because of the 2026 recessionary backlog in corporate HR departments, it took 60 days for the plan administrator to review and qualify the QDRO. During those 60 days, the U.S. stock market suffered a flash crash due to global supply chain disruptions. The total value of Robert's 401k dropped by 25%. Because the legal language in their decree specified a fixed dollar amount of $300,000 rather than a percentage, The plan administrator was legally bound to pull that full amount for Jennifer. This left Robert with only $150,000 in his account. He went from a 50-50 split to owning only 33% of his own retirement savings, simply because of an administrative delay during a market downturn. This is the hazard of the static valuation. To prevent this in 2026, your legal language must be dynamic. You should utilize what professionals call a volatility cap, or a market adjustment clause. This clause specifies that if the account value fluctuates by more than a certain percentage, say 5%, before the distribution occurs, the parties must return to mediation to adjust the dollar amount, or the percentage must be recalculated, based on the new reality. The next critical technicality is the choice between an in-kind transfer and a cash liquidation. In a recession, this choice is the difference between participating in the eventual recovery and being left behind. When a 401k is split, the plan administrator usually asks how you want the funds moved. A cash liquidation means the administrator sells the stocks and mutual funds in Robert's account and sends a check or a wire for the cash value to Jennifer's new IRA. If this happens at the bottom of a recessionary dip in 2026, Jennifer has effectively locked in the losses. If the market rebounds the next week, she has no shares to benefit from that growth. Instead, a savvy strategist in 2026 will push for an in-kind transfer. This means the actual shares of the mutual funds or ETFs are moved from Robert's 401k to Jennifer's account without being sold. Jennifer now owns the same assets Robert did, just in her own name. She hasn't sold at the bottom. She has simply moved her position. This allows her to wait out the 2026 recession and benefit from the eventual upswing. Step by step, you must check with the 401k plan administrator to see if their systems support in-kind transfers for QDROs. Many older systems do not, and they will force a liquidation. If you are forced to liquidate, you must have a plan to immediately reinvest those funds in the new account to minimize the time you spend out of the market. Even 48 hours on the sidelines in 2026 can cost you thousands in missed recovery gains. We must also address the 2026 tax withholding trap. When the money finally moves, the IRS is watching. If the funds are moved via a direct rollover from the 401k to Jennifer's new traditional IRA, there is typically no tax withholding and no penalty. This is the cleanest potential outcome. However, if Jennifer asks the plan administrator to send the check directly to her, so she can use some of it for immediate expenses, the administrator is legally required to withhold 20% for federal income taxes. If Jennifer receives $200,000, the IRS takes $40,000 off the top before she even sees the check. Historical trends show that many spouses make the mistake of thinking they can just put that money back into an IRA within 60 days to avoid the tax. This is known as the 60-day rollover rule. But there is a mathematical catch. Jennifer would have to find $40,000 of her own money to add to the check she received to complete the full rollover. If she only rolls over the $160,000 she received, the IRS treats the $40,000 they withheld as a permanent distribution, and Jennifer will owe taxes on it at the end of the year, potentially with a 10% penalty if she is under age 59 and a half. In a 2026 recession where cash is king, very few people have $40,000 in spare cash to fix a rollover error. You must insist on a trustee-to-trustee transfer to ensure the full amount reaches the new destination without the IRS taking a bite. Furthermore, we must look at the QDRO pre-approval process. In 2026, the complexity of 401k plans has increased with the inclusion of private equity and crypto exposure options. This makes plan administrators more likely to reject a QDRO for non-compliance with plan rules. A rejection can send you back to the beginning of the legal process, costing months of time. To avoid this, you should always submit a draft of the QDRO to the plan administrator for pre-approval before the judge signs it. Most major U.S. employers offer this service. It ensures that when the final signed order arrives, it will be processed immediately. In a recessionary environment, immediately is your best defense against market volatility. Step by step, the execution phase looks like this. First, obtain the plan's specific QDRO procedures and model language. Second, draft the order using the in-kind transfer and gains and losses clauses we discussed. Third, submit for pre-approval. Fourth, once the judge signs, send the certified copy to the administrator via overnight mail with tracking. Fifth, call the administrator every 48 hours until the transfer is initiated. In 2026, bureaucratic persistence is a financial strategy. Imagine if you are the one keeping the 401k and paying out your spouse. Your goal is to move the funds as quickly as possible, so you can begin rebalancing your remaining assets for the 2026 recovery. Every day your ex-spouse's share remains in your account is a day you are carrying their risk. If the market rallies, you are essentially giving them a free ride on your growth. If the market crashes, you are exposed to a potential legal battle over the reduced value. You want a clean, fast break. As we reach the conclusion of this execution phase, you have the assets in your new account. The divorce is final, the money has moved, and the tax traps have been avoided. But now you face the most important question of all. What now? Your retirement pot has likely been cut in half, the US economy is still in the middle of a recession, and the life you planned for the next 20 years has been fundamentally altered. You have the tools to survive the divorce, but do you have the tools to survive the aftermath? In the final part of this deep dive masterclass, we are going to pivot from survival to growth. We will reveal the 2026 post-divorce recovery blueprint. We will look at how to leverage your new smaller account to achieve larger returns as the market begins to bottom out. We will discuss the strategic use of Roth conversions during a recession to eliminate future taxes on your recovery gains. We will show you how to rebuild your credit and your net worth from the ground up, turning this financial crisis into the foundation of your new life. The end of your marriage was the end of a chapter, but the next part is where we write the rest of your story. The 2026 post-divorce recovery blueprint begins the moment the ink on your QDRO is dry, and the funds have landed in your name. For many Americans, looking at an account balance that is exactly 50% of what it was a year ago can trigger a sense of financial mourning. However, historical trends from the 2008 and 2020 market cycles suggest that the period immediately following a recessionary bottom is one of the most significant wealth-building windows in a lifetime. If you are starting over in 2026, you are not just rebuilding, you are recalibrating. You are now the sole decision-maker for your financial future, and in a recessionary environment, that autonomy is a powerful tool for generating what professionals call tax alpha and market beta. Imagine a case study involving a healthcare administrator in Atlanta named Taylor. After a 20-year marriage, Taylor's divorce is finalized in September 2026. The $401,000 they once shared has been split, and after market losses and legal fees, Taylor is left with a traditional IRA containing $175,000. To Taylor, this feels like a catastrophe, but Taylor is 52 years old, and the US economy is showing the first tentative signs of a cyclical pivot. Taylor's first move in the blueprint is the strategic Roth conversion. In 2026, a recession often results in a lower taxable income year for many individuals due to reduced bonuses or career transitions. Furthermore, since the 401k assets are currently at a market low, a Roth conversion becomes statistically more efficient. If Taylor converts $50,000 from a traditional IRA to a Roth IRA while the market is down 20%, Taylor is paying taxes on a smaller valuation for the same number of shares. When the market eventually recovers, all that growth within the Roth IRA happens tax-free. Historical trends indicate that those who convert assets during a downturn often see significantly higher after-tax net worth a decade later compared to those who wait for the market to peak. Step by step, Taylor must calculate the gap between their current income and the top of their 2026 tax bracket to determine exactly how much can be converted without triggering a higher marginal rate. The second pillar of the 2026 blueprint is the utilization of the Secure Act 2.0 catch-up provisions. For those like Taylor who are over age 50, the 2026 contribution limits offer a high-velocity path to rebuilding. In 2026, the standard 401k contribution limit is $23,500, but the catch-up contribution for those aged 50 and older allows for an additional $7,500. Even more specifically, for individuals aged 60 to 63 in 2026, the catch-up limit has been increased to either $10,000 or 150% of the standard catch-up, whichever is greater. By maximizing these contributions during the early stages of a market recovery, Taylor is effectively buying more shares at lower prices, compounding the speed of the rebuild. Now let us look at tactical asset rebalancing. During a marriage, investment choices are often a compromise between two different risk tolerances. Post-divorce, Taylor has the opportunity to align the portfolio with a personal timeline. In a 2026 recession, a common mistake is to become overly conservative out of fear. However, if Taylor has 15 years until retirement, being too heavy in cash or bonds during a market bottom is a recipe for long-term stagnation. Step by step, the rebalancing process involves assessing the current sector weightings. If the 401k was heavy in tech and that sector has been crushed, Taylor might reallocate toward undervalued sectors like healthcare or energy, which historically show resilience during the later stages of a U.S. recession. Potential outcomes are far more favorable for those who maintain a disciplined, diversified equity exposure, rather than those who retreat to the perceived safety of low-yield savings accounts. We must also address the psychological and logistical recovery of credit and liquidity. A 2026 divorce often leaves one or both parties with a bruised credit score due to the closure of joint accounts or the high utilization of credit cards for legal expenses. This is a silent drain on retirement potential because high-interest debt is the inverse of compound interest. Taylor's blueprint includes a strict debt snowball strategy, prioritizing the elimination of any debt above 7% interest. This frees up monthly cash flow that can then be diverted back into the retirement engine. In the 2026 economic climate, where borrowing costs remain elevated, liquidity is your best defense against future volatility. One of the most overlooked steps in the final blueprint is the comprehensive beneficiary audit. This is where many people experience a post-divorce legal disaster. Most people assume that their divorce decree automatically removes their ex-spouse as the beneficiary of their retirement accounts. This is a dangerous misconception. Under the Employee Retirement Income Security Act, or ERISA, the plan administrator is generally required to pay the benefit to whoever is named on the beneficiary form, regardless of what the state divorce decree says. If Taylor forgets to update the beneficiary form for the remaining $175,000 and passes away, that money could go directly to the ex-spouse, leaving Taylor's children or new partner with nothing. Step by step, you must contact every financial institution for 401k, IRA, life insurance, and even your health savings account to update these designations immediately after the QDRO is processed. Imagine if Taylor also uses this moment to establish a new estate plan. In 2026, the use of a revocable living trust is becoming a standard tool for divorcees to ensure that their hard-won retirement assets are protected from future creditors or a second divorce. By naming the trust as the beneficiary of certain assets, Taylor can provide for their heirs while maintaining a level of control that a simple beneficiary form doesn't allow. This is the transition from being a victim of a financial split to becoming the architect of a multi-generational legacy. As we conclude this deep dive masterclass, we have to look at the macro perspective. The U.S. economy has endured dozens of recessions, and the family court system has processed millions of divorces. Those who thrive in the aftermath are those who treat their 401k not as a static number, but as a strategic asset. You have learned how to value the account during a downturn, how to navigate the tax traps of the QDRO, how to handle the minefield of 401k loans, and how to track down hidden executive compensation. You have been given the tools to survive the administrative lag and the market volatility of 2026. The 401k divorce in a recession is a test of resilience. It is a mathematical puzzle and a psychological marathon. But as history shows, the recovery that follows a recession is where the most significant gains are made. By applying the strategies we have covered, from the specific legal language in your decree to the aggressive catch-up contributions in your new life, you are positioning yourself to ride the wave of the next economic cycle. The split was the end of one journey, but the blueprint we have built together is the starting line for your ultimate financial independence. You now possess the literacy, the tactics, and the roadmap to turn a 50% loss into a 100% fresh start. This is the masterclass in survival, and now it is time for you to execute the plan.